Welcome to Talk Tickers. We're diving straight into the latest earnings call today, pulling out the key stuff for you.
Yeah, let's get right to it.
So the big picture first. Net sales were $934 million. Flat year over year, technically.
Right, and this is the interesting part, that actually outperformed customer production by a pretty significant 10%.
10% outperformance. Okay, that definitely catches the eye. What else on the surface?
Well, adjusted EBITDA hit $129 million. That's a margin of, 13.8%.
Pretty healthy margin. And cash flow?
Adjusted free cash flow came in at $38 million. And they pulled in some strong new business wins, too.
Ah, yes. $1.9 billion, wasn't it? Driven by displays and digital clusters, mostly.
Exactly. And speaking of displays, that was a real standout. Sales up 50% year over year.
50%. Even with overall customer production being down.
Yep. Despite lower production, it really suggests those display products are hitting the mark.
Okay, so let's dig into that a bit more. That flat overall sales number hides some regional differences, I assume.
Oh, definitely. The Americas and Europe actually saw growth. Seems like recent product launches, especially in display and infotainment, really gave them a boost there.
Makes sense. New tech adoption.
Right. Plus, the commercial vehicle side helped in Europe, too. And India showed growth as well, driven by some partnerships and the two-wheeler market.
Okay, so positive signs in several areas.
Yeah.
But what about China? That's always a big piece of the puzzle.
Yeah, China was tougher. Sales declined both year over year and sequentially.
Which was expected, though, right? Given the global OEM situation there.
It was tied to those global OEM market share losses and also lower export volumes from the domestic Chinese OEMs they work with.
But wasn't there a slight silver lining? Something about stabilization.
Well, yes, potentially. It looks like the global OEM market share in China kind of stabilized sequentially in Q1, and Toyota actually gained a bit of share.
Interesting. So maybe the bleeding stopped, at least for now.
Could be. It's something to watch, for sure.
Okay. Shifting gears to costs. Anything noteworthy on the engineering side?
Actually, yeah. Net engineering costs were down year over year, came in at 5.6% of sales.
Lower. How come?
Mainly lower personnel costs, it seems, and also just some favorable timing on expenditures.
Got it. And the balance sheet. How are they looking cash-wise?
Pretty strong, actually. They ended the quarter with $658 million in cash, and $343 million of that is net cash.
Solid position. Did they return anything to shareholders?
Did, yeah. $7 million through share repurchases, but then they paused that activity.
Paused. Why?
So.
Wait. Let me guess. Tariffs.
You got it. The uncertainty around potential tariffs seems to be the main reason for hitting pause there. Build up the cash buffer,
Makes sense. Okay, let's talk about those new business wins. $1.9 billion is a big number. What were some of the highlights?
Some really interesting ones in there. A big one was a 12-inch digital cluster for a key large SUV platform for Toyota that covers both mass market and their luxury brands.
Right, I saw that. And another Toyota win, too.
Yeah, a separate 12-inch driver display specifically for a Toyota luxury vehicle.
Okay. What else stood out?
Well, this is significant. Their first business ever with the VW Group's Scout brand.
Scout, the new electric SUV and truck brand.
That's the one. They're supplying a 16-inch center display for that platform. So a brand new customer and in the EV space.
Wow. Okay, that's a key win. Any movement in China on new business?
Yes, they landed their first deal with Chery, one of the big Chinese domestic OEMs.
Right, Chery. What's the product?
It's a 25-inch curved display module for a couple of SUV models they plan to export.
Interesting. So working with Chinese brands targeting markets outside China.
Seems like part of the strategy. And they also had wins in India's two-wheeler market with Hero MotoCorp and Royal Enfield. Digital clusters again, some with integrated connectivity.
They seem strong in that two-wheeler space in India.
Definitely building momentum there. And one more big one, a battery management system, or BMS, win.
EVs again. Who's the customer?
A luxury OEM in Germany. It's their fourth BMS customer overall, and the second one in Europe. It's for a new EV platform launching in 2028.
BMS is critical for EVs. Getting traction there is important.
Absolutely. And this win involves systems supporting 408-volt architectures.
Okay, quite a haul on the new business front. Were they launching products too, or just booking future orders?
No, they were busy launching too. 16 new product launches just in Q1.
16. Wow. Across the board.
Yeah, digital cockpit stuff, BMS products, on vehicles all over the world. And importantly, a good chunk were on mass market vehicles and also included hybrid electric powertrains.
So hitting the mainstream and the transition vehicles.
Exactly, covering their bases.
All right, let's pivot to the topic that caused them to pause buybacks, tariffs.
Sure.
What's the situation?
Okay, so right now, the vast majority of what they ship into the U.S. from Mexico, about 97%, is USMCA compliant.
Meaning no tariffs currently apply.
Correct. But there's this potential new 25% tariff being discussed. It would target the non-U.S. content of auto parts coming in from Mexico.
And that would hit them.
It could, yeah. The estimate is it might affect around $10 million worth of their products each week.
Ouch. And the cost impact.
Potentially around $2.5 million per week if that tariff goes through as proposed. They did mention the administration is looking at ways to lessen the disruption, but it's a big unknown.
$2.5 million a week is not small change. So how does this uncertainty impact their guidance for the year?
Well, it impacts it significantly because of this increased uncertainty, not just from the tariffs themselves, but also how they might hit overall industry production.
Right, because forecasts are all over the place now.
Exactly. Some predict maybe a 1% decline, others are talking high single digits. So given all that, the company decided not to reaffirm their full year guidance right now.
So they're pulling back from their previous forecast.
Essentially, yes. They said before all this tariff talk flared up, they were actually tracking in line with their original guidance, and they expected Q2 to be pretty similar to Q1, with EBITDA margins maybe normalizing around 12%.
But now it's just too unpredictable.
That seems to be the message. Holding off on reaffirming highlights just how much uncertainty they're dealing with.
Are they just sitting back and waiting, or are they actively trying to manage this risk?
Oh, they're definitely active. They've put together a cross-functional task force specifically to work with customers and try to mitigate the impact.
What kind of mitigation are we talking about?
Things like trying to simplify the supply chain. One goal mentioned was to have about a third of the sales from their Mexico plants actually shipped within Mexico, avoiding the U.S. border crossing altogether.
Ah, okay. Localizing more.
Right. And they're looking at resourcing options, evaluating different production locations, basically trying to build more flexibility.
And if they do get hit with tariffs, they can't mitigate.
The intention, they stated, is to pass along any remaining costs to their customers.
Which is standard practice, but not always easy.
Never easy. And as we mentioned, they paused the share repurchases too. Focus is on cash preservation and keeping the balance sheet strong with all this going on.
Makes sense. Let's circle back to China quickly. Given the challenges, what's the longer-term plan there?
They acknowledge it's tough. The strategy seems to be a mix, working with select domestic OEMs, especially those like Chery, who have global plans.
Right, the export focus.
And also sticking with the global OEMs they think will maintain a decent share in China. They specifically mention German luxury brands and Toyota.
So, picking their partners carefully, what are the expectations timeline-wise?
They see this year as a transition year for the China business. They're hoping for some slow growth next year and maybe getting back to the sales levels they saw in 2023 or 2024 by sometime around 2027, 2028.
So, a multi-year view.
Yeah.
Not expecting a quick rebound.
Doesn't sound like it. More like navigating a complex market strategically.
Okay. And one last specific area, the BMS market. Anything else from the call on that?
Just that they expect North American BMS sales to be a bit lower this year.
Lower. Why is that?
Partly customer inventory levels, apparently, and also a planned factory shutdown at GM during Q1 impacted things.
Okay. So temporary factors mostly.
Seems like it. But that new win with the German luxury EV maker really underscores that their BMS tech is competitive, especially on cost and performance, which is, crucial in the EV space.
Right, reinforces their position there despite the short-term North America dip.
Exactly. It shows they're still winning key battles in that important market.
Okay, great. That covers the earnings call details really well. Now let's shift to our favorite segment. This is not financial advice.
But here's a wild idea. Okay, I'll go first.
Go for it.
All right, so think about Vichyans' strength in displays. That 50% growth, the big wins. The whole digital cockpit thing is huge for car buyers now, right?
Definitely a major selling point.
So here's the outrageous but plausible idea. Given Vichyans looks pretty well positioned here, maybe consider a long position in companies that are really leaning into that in-cabin tech experience. Think automakers known for great interiors and tech integration. And maybe, just maybe, you could look at potentially shorting companies whose display offerings or overall cabin tech feel, well, a bit behind the curve, playing that trend of the cockpit as a key differentiator.
Interesting. Betting on the importance of the screen, essentially, and Visteon's role in supplying it. I like it. What's your second idea?
Okay, this one ties into the tariff mess. It's a paired trade concept.
A pair trade. All right.
So with all this tariff uncertainty and seeing Vichyans proactively setting up task forces, looking at supply chain shifts, you could maybe go long Vichyans.
Betting they navigate it better than others.
Exactly. Betting they manage the disruption, maybe even gain some share if competitors get hit harder. But then you pair that long with a short position.
Shorting who?
A competitor. Specifically, one that seems heavily reliant on imports from regions facing those higher tariff risks, like non-USMCA stuff coming into the US, and who doesn't seem to have as much manufacturing flexibility, maybe less presence in Mexico or the US already.
So betting Visteon's flexibility and proactive stance gives them an edge if tariffs really bite.
Precisely. It's a bet on relative performance in a potentially messy environment. Again, totally speculative, not advice.
Understood. Fascinating ideas, though. Definitely playing on the key themes from the call. So, to wrap up our deep dive, we've hit the financials, the big wins in displays and BMS, the considerable uncertainty around tariffs, and their strategies for China and EVs.
Yeah. Quite a bit to unpack from one call. The tariff situation is definitely the big question mark hanging over things right now.
It really is. We hope this breakdown gave you some valuable context. What do you think? How will these potential tariffs shake out for the auto industry? And is Visteon's focus on displays the right horse to back for the future?
We'd love to hear your perspectives.
Definitely. Join the conversation. This has been Talk Tickers. Thanks for tuning in. And remember,
nothing we discuss today is financial advice. Do your own research.